the show where our team at CNBC TV 18 gets you the top stories of the day. I'm Arif Shirwani and you're watching Reporter's Diary. Right, so we'll get you all those headlines in detail, but first let's go to Dalal Street, where weak global cues and continued FII selling dragged the markets for a second consecutive day. Benchmark shed 1% in trade. The Nifty gave up the 10,700 mark amidst a sell-off in banks, oil as well as gas and metal stocks. The Sensex also shed almost 400 points, but managed to hold on to the 35,500 level. Mid-cap succumbed to selling pressure post-lunch to end with cuts of 150 points. The Bank Nifty, meanwhile, giving up 27,000 as it shed nearly 250 points. Let's get you the big CNBC TV 18 exclusive news break now. The central government is working on a multi-pronged strategy to address agri-distress. This even as it continues to study the feasibility of basic income support for farmers. Now, sources tell us that the centre may instead go ahead with a package aimed at reducing input costs and improving income security for farmers. Parikshit Luthra is here with the exclusive details. Parikshit, what are the options that are under consideration currently?
We're hearing from our top sources in the government that the centre is discussing the possibility of bringing in universal basic income, but no decision has been taken as yet. There are concerns in the government. There are reservations with the cost to the exchequer. This scheme would cost about 2.1 lakh crore rupees, and this is a huge cost to the government in an election year. There are officials who believe that the government would be better placed to actually focus on existing schemes and their better implementation. Very soon we could hear the government announce 4 to 5 measures as a comprehensive package for farmers across the country. So what are some of the changes that are being looked at? Sources are telling us that all the changes would be aimed at income security, at reducing the input costs, increasing the MSP of crops, and at the same time provide additional sources of income for farmers across the country. There are also changes being looked at in the Pradhan Mantri Fasal Bima Yojana to ensure better implementation, faster settlement of claims. We're also hearing that the government is likely to include damage by animals to crops in the Pradhan Mantri Fasal Bima Yojana. This has been a demand from farmers across the country. As far as the KCC is concerned, the government is looking at several measures. Number one, to increase collateral-free loans under KCC to about 2 lakh rupees. Also include livestock farmers under KCC. This is something that could be announced in the weeks and days to come. At the same time, push for wider coverage of the KCC scheme. Currently, the scheme covers only about 50 to 55% of the farmers in the country, and they want to extend it nationally to more farmers and bring more farmers under the net. They're also saying that they're looking at converting KCC cards to RuPay cum debit cards so that farmers have more income in their hands, and not just the Raitu Bandhu scheme, but schemes of Haryana, Madhya Pradesh and Rajasthan are also being looked at. And very soon there could be some good news for farmers in the country. This is something that Gajendra Singh Shekhawat, MOS Agriculture, also told CNBC TV 18.
Right, Parikshit, absolutely. Many thanks for joining us with that big story. In fact, we're breaking another big story at this hour. The cabinet likely to take up the new industrial policy this month. In fact, we learned that the DIPP has already issued a cabinet note on that matter. Rituparna Bhayan broke that story and he joined us with all the details. Ritu, what are you picking up?
Whenever this is approved, this will be India's third industrial policy since independence. According to our sources, this industrial policy, the plan is to basically, take it forward through a multi-tier central and state level, mechanism. There will be an apex committee to be chaired by the Commerce Minister, which will have central and state ministers, and then you'll have central and state level committees where officials will be present, and they will be the ones who will be taking forward this industrial policy. Now, what are the specific proposals within this industrial policy? One is, of course, a civilian offset for sectors like ICT and electronics. As of now, offsets are seen only in the defense sector. Also, tax incentives for clean and green products that is being proposed. Policy support for ready-built factories for MSMEs. Scaling up peer-to-peer lending for MSMEs, also phased manufacturing programs and aligning the customs duty related policy with it, which means that we could see customs duty being increased to promote domestic production. Last but not the least, targeted fiscal incentives for labor-intensive sectors. That is also being proposed. Of course, the policy as of now does not have those sectors on which these incentives will be given to. But we have been told that within this month itself, the cabinet could take up this new industrial policy for approval. With that, it's back to you.
Right, Ritu, do hang on though. Let's talk about the other story that you've been tracking. So in a move that could strengthen the government's argument against stricter banking regulations, a parliamentary committee on finance has expressed concerns over Reserve Bank's capital adequacy ratio mandate. The panel has also questioned the results of RBI's prompt corrective action framework. Ritu, can you take us through the key highlights from that report as well?
It's a pretty elaborate report. Let me start with what the panel has said on CRAR, where it has said that the current norm of 11.5% as mandated by the RBI is unrealistic and unwarranted. And if some of this is waived, then up to 5.34 lakh crore could come back into the banking system. Concerns have also been expressed on loan write-offs as well as declining deposits in public sector banks. But the panel has said that the present crisis is transient and hence should not become an alibi for privatization. As far as HR issues are concerned, the panel has said that the climate of fear and uncertainty should not be created amongst bankers because that will be counterproductive. As far as NPAs are concerned, the panel has said that NPAs should be divided into two categories. One is NPAs by willful defaulters, and secondly, NPAs that happen because of extraneous reasons on which business houses do not have any control of. Knee-jerk reactions like stopping of LOUs, that should be avoided. As far as the PCA framework is concerned, RBI coming in for criticism by this panel, saying that the objective of this PCA framework has not been achieved. That is because parties with NPAs have no motivation to pay back. Now it remains to be seen how much of these recommendations are accepted by the government going forward. With that, it's back to you.
Right, many thanks. So Rituparna Bhayan there getting us all the details from that story. But continuing with stress in the banking sector, banks have written to the new RBI Governor Shaktikanta Das on issues faced by them. Ritu Singh joins us now with more details. Ritu, what are the contents of that letter?
Well, sources have told CNBC TV 18 that banks have written a letter to the new RBI Governor Shaktikanta Das on several concerns faced by the banking industry, and this letter was sent soon after the governor met with all bank chiefs in the month of December. Now, first on the issue of the Feb 12 circular on bad loans, banks have once again requested that RBI do away with the one-day default rule and instead allow financial resolution to start only after 60 days. Among other things, banks have also requested that NCLT referral for initiating bankruptcy proceedings only happen after 60 days of a resolution plan failing instead of 15 days as is currently stipulated. Secondly, on the more important and pressing issue of the IL&FS group loans, banks have expressed concerns that lenders have so far been restrained from initiating any enforcement action for the recovery of their dues because of the NCLAT order, and that a substantial portion of the 60,000 crore exposure of the banking system to this group is at the risk of becoming non-performing is if RBI does not intervene, and therefore banks have sought a standstill agreement or arrangement for these loans for a period of at least 6 months. Third, banks have also sought relaxation in risk weights for exposures to corporates and retail in line with Basel III requirements, which will allow capital requirements to come down anywhere between 25 to 40 basis points across banks. Fourth, banks have also sought a one-time restructuring relief for MSME loans, which we know RBI has now recently allowed. Also on the issues of ATMs, bank did seek various relaxations on cassette swap rules and the change of EVM chip cards, etc. And we understand that RBI officials will be holding a meeting with the banking industry body IBA on the 17th of January to address some of these issues.
Right, Ritu. Many thanks for joining us with all the details from there. But some sobering news as well. Fresh investments into the economy have stagnated to their lowest level in the last 14 years. In fact, that's the crucial finding of a report released by the Center for Monitoring the Indian Economy. In the third quarter of the financial year, the reports say new investments dropped to 1 lakh crore rupees, which is the lowest since mid-2004. That's not all. The rate of stalled projects also continues to be high at over 3 lakh crore rupees. We spoke to Mahesh Vyas, the MD and CEO of CMIE, and he says that the trend of falling investments is not new. It has been ongoing for the past 2-3 years. He's also added that demand is a bigger problem for stalled projects than funding in itself. Let's hear out what he had to say.
capital goods companies could be doing well, and we will not dispute that. The numbers at a macro level for investments are, as you rightly put it, sobering. So we see new investment projects being announced actually falling, and this is not a plunge. It is not a sharp decline, but is a part of a steady decline that has been happening for the last 3.5 years. You see this increase in stalled projects and decline in new investment projects leads to a fall in the outstanding projects itself. So we are seeing the stock of investments on hand actually having fallen and fallen quite a bit. If you really have a very difficult balance sheet, then obviously you have a financing problem. But if you have a decent project, then nobody says that financing is a problem. The recent refinery that got stalled because it had land acquisition problems, and it just couldn't get off the ground. A lot of projects have been commissioned already, and capacity utilization is still low. So the expectation of capacity utilization rising, what we saw in Ubicus in June 18, has actually come down again. So the problem is more to do with demand.
So there you have it. Fresh investments into the economy have been steadily stagnating. That's the word coming in from CMIE. On that note, we slip into a short break. Coming up on the other side, the Supreme Court revives the class action lawsuit against Nestle filed by the government in the National Consumer Disputes Redressal Commission. That and more on the other side.